value trades, Forex, CFDs, and commodities.
Okay, there we go, ladies and gentlemen. So good evening. Here we are. It's a Tuesday, the 7th of August already. We're into the sort of what's normally a little bit of the low period of the sort of the trading year in terms of the sort of the summer period. But as always, there's an opportunity for us to learn and to develop as traders. And in this particular case, what we're going to be covering this evening as part of the value trade series of webinars this year is that we're going to be talking about an introduction to trading currencies using the MACD indicator, an indicator that has been prevalent for decades now. Very well used throughout the trading community, and something that is can provide you with a quite useful opportunity if you know how to use it properly. And by the end of this session, I'm hoping that you'll be enlightened and able to utilize that. But as always, I'm just going to start with a quick risk disclaimer. CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. 69% of retail investor accounts lose money when trading CFDs with this provider. You should consider whether you understand how CFDs work and whether you can afford to take the high risk of losing your money. The information of this webinar is not directed at residents or nationals of the United States, not intended for distribution to or use by any person, any country or jurisdiction where such distribution or use would be contrary to local law or regulation. The presenter is liable for his comments and do not endorse the views. Non-advisory broker, and you should seek independent financial advice. So, trading currencies with MACD. So I appreciate that some of you here joining us this evening, you're watching the video later on demand. Some of you may well be aware of MACD. Some of you may not actually really truly understand what it is. Some of you may already be using it, but wanting to understand how you can get more from the actual tool in your trading. So what I'm going to cover today for our session is I'm going to talk a little bit about an introduction about where MACD has come from. What I'm also going to talk about is how the MACD is created, to give you a little bit of a little bit of deeper insight into the sort of the tool itself. I'll also give you 3 ways to use MACD to trade currencies. And in particular, I'm going to focus on divergence, which we'll talk about in terms of how to use that to give you a trade plan, a trade strategy, a trade entry system. Talk about the importance of a confluence of events. And I'm also going to talk a little bit about sort of the difference between traditional MACD and MetaTrader 4 MACD. And some of you may already be aware of that. If not, I'm hoping that this session will actually help to try and educate you upon that. Then if there's any time at the end, we'll take a quick look at the charts and see if we can have a look at, how MACD can be used in sort of, the currency markets with what we see happening, this very day. So as always, if you have questions, feel free to ping them into the chat box. I will try and do as best as I can to answer them as we go along. If you're watching this on demand later on, as part of the webinar series, well then, and you have questions, by all means, please get in touch with your account representative, and they'll be very happy to sort of help you in any way possible with your queries. So, what is trading currencies with MACD all about? Well, I suppose it would help if we had an understanding of what actually MACD is to begin with. What is it? As I said, some of you may be aware of it, some of you might use it, some of you, might never have never heard of it at all. MACD, well, that is the moving average converse divergence indicator. It's a snappy name, as I'm sure you can hear that, but it's pretty much everyone just calls it MACD. And it was created back in the 70s by a gentleman called Gerald Apple. Really, when you look at this, what happened is, in the 70s and 80s, as computers became more prevalent, especially in, with sort of trading houses and with analysts, they were able to start to sort of collect the data and create and utilize that and build indicators from it. And that's where we saw, in the 70s and 80s and into the 90s, we saw, it's almost like explosion of various indicators that that have been came to know and be used and loved today, from stochastics to CCI to RSI and also towards MACD. If you want to really go into depth about MACD, he wrote a book on it called the Moving Average Convergence Divergence Trading Method. So you're very welcome to sort of pass the winter evenings taking a long read through that. But today, what we're going to talk about really is, how it's created, what it shows, and more importantly, ladies and gentlemen, how you can use it tomorrow in your trading, because that's what all of these sessions are about. Is about providing you with a range of sort of time frame and instrument agnostic tools and ideas and concepts that you can utilize in your trading tomorrow across all time frames and instruments. And certainly MACD is one of the ones we'll be able to utilize in your trading. So what we'll just put as a couple of caveats is, MACD tends to work best when, used in trending environments rather than range bound. And, we'll have a look at a couple of the charts of certain of some of the markets and instruments over towards the end of this session. We'll be able to talk through that, okay, and have a look at it. But as a general rule, what we're looking to use MACD for is an idea to see, where a trend reversal is happening and a new trend is starting, okay, and that's where we're looking to sort of make the most of the opportunity. As I said, it can be very useful to help signal the start of a possible new trend, or actually the end of an existing one. If you're already in a trend trade, well then actually what we'll teach you this evening might actually help you use the MACD to give you almost like an early warning when you're sort of the trend is actually coming towards the end, when it's starting to run out of steam and getting ready to roll over. So how is MACD created? Okay, what actually happens when when you pick up the MACD indicator off MetaTrader, sort of the MetaTrader charting platform? Well, we'll show you there in a moment, how you can do that and how it'll actually, where you can select it and how it'll represent itself on the Value Trades MetaTrader 4 charting platform. But what we're going to talk about here for the majority of the session is what I'm going to term as a traditional MACD. Okay, and hopefully in a few slides later you'll understand that, where there's a slight difference between traditional MACD and how MetaTrader 4 displays it. So I'm going to give you the sort of the basis of traditional MACD, because I appreciate some of you will have had experience from that. Some of you may have a particular version of it that you can utilize in MetaTrader, but it all will become clear as we go through the slides. So with a traditional MACD, okay, you see a combination of two different types of indicator. And you can see there on the right hand of the chart there, we know that's actually what a traditional MACD indicator would look like on your chart. There's firstly the MACD employs two moving averages of varying lengths to identify the trend and the direction. And then on the traditional MACD, it takes the difference between those two moving averages and plots that as a histogram, and this is used to identify momentum. So if you're not really sure what a histogram is, the histogram would be the sort of the kind of vertical green bars that you would see on this particular sort of little chart to the side. So as I said, it's effectively it's a couple of indicators in one. Okay, you've got the sort of two moving averages, okay, to give you trend and direction, and then the histogram to identify momentum. So some of you may be aware of that. Some of you, may not have sort of delved too deep into MACD itself. But hopefully by the end of this particular session, you'll have a far greater understanding of what MACD is and how we can use it as traders. So what you'll see with traditional MACD, and hopefully you can see there in the sort of the top left, is that you will see three numbers. All right, you normally get an opportunity to select three numbers. The first number, okay, is the number of periods that is used to calculate the faster moving average, which will often be called the MACD line. In that particular chart, that's the blue line, okay, that's the MACD line. The second is the number of periods that is used in the slower moving average, the signal line, which would be the 26 or the red dotted line here. And the third is the number of bars that is used to calculate the moving average of the difference between the faster and slower moving averages. So in this case, it would be 9, and that's what goes to create the sort of the green histogram in that particular example. So that might That might be a little bit confusing, but bear with me, ladies and gentlemen, as we go through a few more slides. We'll explain how that data is created, how it actually comes together, and what it represents. Well, then hopefully it will become a little bit more apparent and clear to you. So what you'll find with the majority of traditional MACD indicators across any sort of charting platform, very often you'll see that it's a sort of traditional MACD settings are 12, 26, and 9. Okay, and what does that represent? Because sometimes there is a little bit of confusion about this. The 12, okay, represents the previous 12 bars of the faster moving average. The 26 represents the previous 26 bars of the slower moving average, or the signal line. And the 9 represents the previous 9 bars of the difference between the two moving averages. This is plotted by those vertical lines called the histogram, which is the green lines on the chart. Okay. So Armin's just asking a couple of questions there, and they're good question, Armin. And if you don't mind, what we'll do is I will answer that when we just get to a couple of the charts and slides, because I'm going to show you how to sort of overcome the element that you've used in your question. So good question. If you bear with me, just give me a couple of slides, and we'll actually go through and talk about that in terms of how to utilize that. So there is as I said, there's a little bit of a common misconception when it comes to the lines of the MACD. Okay, the two lines that are drawn are not moving averages of the price. All right, very often, sometimes people think that they're the moving averages of the price. They are not. Instead, they are the moving averages of the difference between the two moving averages. Okay, so they are not the moving averages of the price. They are the difference between the moving averages, the difference between the two moving averages themselves. And this becomes kind of important because it's what we utilize to sort of give us the indication of trend, direction, and momentum. So how do we utilize that sort of data to analyze markets? Well, I'll show you in detail in a slide or two, but what we look at is when MACD is positive and the histogram value is increasing, then upside momentum is increasing. And not surprisingly, we would be, for the most part, have a sort of a bullish bias. When the MACD is negative and the histogram value is decreasing, then the downside momentum is increasing, and we would be sort of have a bearish bias. And if we we'll go to the a few more slides, and we'll actually look at the charts. I'm just going to show how that actually is represented, and we'll show what that actually means and how we can analyze that and utilize that to sort of make the trading decisions. So what's the ways that actually people utilize this to sort of help them trade currencies with MACD? Well, the sort of first way you can utilize, and the simplest use of it, is a signal line crossover. So the signal line is effectively calculating the moving average of the MACD line. So it is always lagging. Okay, it is always lagging. It's always slightly lagging behind price, because remember, the signal line is essentially an indicator of an indicator. So it is always going to be a little bit of lagging behind price. So in this particular case, that's that would be the sort of the red dotted line on the MACD indicator. That's the signal line. That is always going to be slower. That is always going to be lagging. And we're going to talk about how we can overcome that in a couple of slides time. So when we see that faster moving average, or what we'd call the blue line or the MACD line, when we see that cross above or below the signal line, that can potentially signify the start of a possible strong move. Okay, so that is the most simplest way to use the MACD, namely that when we see a crossover of the signal lines, that is a way to give us an indication of a possible trade setup. So What I've got here is this is a chart here. This is the US dollar against the yen. This is a weekly chart. For those of you who are completely new to trading, what we have here is I just have I have sort of a green bullish, blue bearish candles. I have a blue 20 period simple moving average, a red 50 simple moving average, and a green 200 period moving average. And what I have here is a MACD traditional. Okay, this is a MACD traditional, and we're going to explain that a bit more in a moment. And hopefully, what you can see here is where the sort of we have the red triangle is that what we had on the weekly chart was we had the cross. Okay, the MACD line, the blue line, crossed the signal line, the sort of the red dotted line, and that was an indication that the market was about to turn. In this particular case, the downtrend was coming to an end, and we can see that actually price rallied there quite nicely for well, as a weekly chart. That meant it rallied quite nicely for the next couple of months. So that was we're looking at as a bullish signal line crossover. Very, very as I said, the sort of kind of the simplest way to use the MACD to trade currencies, to look for a signal line crossover. On the other side of it, we have a bearish signal line crossover. Okay, so here I've got a chart of the this is the dollar Swiss. Okay, US dollar Swiss franc on a 15-minute chart. Okay, as I said, I try and show lots of different time frames, lots of different time currency pairs to show that the MACD is valid across all of the all across the currency pairs. And what we actually see here is, hopefully you can see I have once again the traditional MACD here. It's got the standard 12, 26, 9 settings. And what we had is this is a bearish signal line crossover. So we had the faster MACD, the blue line, crossing below the sort of the slower lagging dotted red signal line, and that was a bearish signal for us, an opportunity to short that particular currency. And we can see that this price actually drifted its way down there for the remainder of the session. So what I would say is that as I said, this is kind of almost like the sort of trading strategy one for trading currencies with MACD. It is the simplest of the sort of the ways to trade it. Just looking for a cross of the MACD line across the signal line. It tends to, in my experience, it tends to sort of be favored more towards kind of longer term trading, but some people will try and use it on shorter time frames. A lot of that is to do with your own risk profile, and that understanding your own risk profile. Well, that's a webinar in itself, ladies and gentlemen. So that was the first and simplest way to sort of trade currencies with MACD, using a bullish or bearish signal line crossover. The second way that you can trade currencies with MACD is what is known as a zero line crossover. All right, it's a very similar premise to the signal line crossover, and it occurs when the MACD line, the blue line on a traditional MACD, crosses the zero line and becomes positive. So basically it's where it becomes above zero, and negative when it's below zero. So hopefully maybe you can see the the histogram there. Okay, is is the green vertical blocks, and there is effectively a zero line there across it, where we can see prices goes up, or rather the indicator goes above and below it, and quite often that traders will use a zero line crossover by the sort of the faster MACD line. When that crosses above the zero, that will be used as a trigger to sort of initiate a long position. Or alternatively, when it actually sort of crosses to the zero to the downside, that would be a trigger to initiate a short position. And so that's what people would use in terms of looking at that. So here we go. So here we go. This is a little bit of an example. All right. So here we have, this is the, once again, this dollar yen on the weekly chart. And, this is actually, I kind of wanted to use this chart because what we saw here, you see the first, arrow, this down pointing arrow was effectively, that was the signal line, the bullish signal line crossover that we looked at a couple of slides back. We can see that there, but then actually what happened is, we can see that price, it reversed and it started to move north, and then we can see hopefully with a second arrow where it's pointing where effectively the blue MACD line crossed the zero line. Okay, you can see that on the far right. See that on the far right there. Let's just see if I can use some of the super drawing tools that we have here on the thing. Let's hopefully that'll work. So here we have the here we go. Here we had the sort of the signal line crossover, the bullish one. But then actually what we can see here, this is the zero line here. And when the price crossed it here, that was your chance to sort of initiate a long position. Now we've just talked a little bit about risk profile, namely about understanding your risk profile. Okay, there will be some people who looking at that chart would have been very happy to sort of take a long position here at the signal line crossover. There are other people who are more risk averse, okay, and would want more confirmation, and so they will say, well, I'll wait until the MACD line crosses the sort of the zero on the histogram, and then I look to initiate my long position. So what they're looking to do is they're looking to try and mitigate the risk. Okay, they're trying to offset the risk, but trading is all about risk and reward. It's all about risk and reward. Okay, so you might be offsetting risk, but on the flip side, you're also offsetting reward, because if you wait to enter the sort of the trend until it's actually the MACD line has crossed the zero level, well then actually you'd be entering the market here as opposed to down around about here. Okay, so this is as I said a slide or two ago, it's about risk profile. It's about understanding your own risk profile. Those of you who are very accepting of risk, okay, would maybe look at signal line crossovers. Those of you who are very risk averse might sort of veer towards the zero line crossover. And that kind of links into, I think, one of the questions that just popped up there, which was really about trying to understand that. Okay, about if you wait for a zero line crossover, yeah, you are you're getting more confirmation, but with more confirmation becomes less reward, and that is that's almost like a conversation to have with yourselves, ladies and gentlemen. That's about working out and understanding what type of trader you are. Okay, are you someone who's very risk accepting, or are you someone who is who actually is risk averse and needs more confirmation before they'll actually take that position? So here's a sort of a negative zero line crossover example. What have we got here? This is the dollar CAD, okay, on the daily chart. We can see that here we go. Let's use the pen. We can see that in a nice way, what we saw was price was the 50-period moving average was acting as dynamic support there up until we had a close beneath it. Okay, we had a close beneath it, which actually was happened around about just a little bit after we had a bearish signal line crossover there. Hopefully you can see that. Okay, but once again, as I said, some people would be not too sure about that, as that might be too aggressive as a particular sort of a trade entry trigger for them. So they might be waiting to see, well, when and if the MACD line crosses the sort of zero level on the histogram, that would be when I would look to to initiate my short position, and that would have happened there when it's completed. Okay, when this candle that period completed, that day completed, we can see that click, that the MACD line, the faster MACD line, is beneath the zero level on the histogram, and that's that would be when, let's say, the more risk averse trader would look to initiate their short. But as we've just talked about, there is it's all about understanding that risk and reward balance. That would have meant that you would have probably been sort of entering the trade around about here rather than here. So Yes, you're getting more confirmation, but with that, you know, it actually might have even been down here. With that, you're also giving up more reward. Okay, so as I say, that's a little bit of homework for yourselves, ladies and gentlemen. Sit down and, you know, think about, you know, what type of trader you are. Are you someone who is very risk acceptance, or are you someone who's risk averse? You know, I would say there's no right or wrong in that particular conversation with yourself. It's about actually knowing who you are. Okay, if you find yourself that, you know, you are actually a very risk averse person, but you are trying to force yourself to sort of trade the signal line crossovers, well, then you might struggle to sort of follow that as a trading plan, because it doesn't fit in with your own personality and belief and trading style. You know, or alternatively, you know, if you're a very, you know, let's say an aggressive trader, and you're waiting until, you know, you see a crossover of the 0 line from the MACD line, well, then you might find that frustrating, because you actually, you know, you're missing out on chunks of profit because of, you know, the sort of the trend has already started. So it's about, you know, what I'm trying to do is give you opportunity here, options that will hopefully sort of tie in with the various forms of let's say risk appetite within the room here. So hopefully that gives you a little bit of sort of food for thought, a little bit of homework for you to go away and actually work out what type of trader you are, because that will, you know, that will have a knock-on impact into how, you know, how you particularly trade. So that was the kind of the signal line crossovers and also the 0 line crossovers. You know, there's sort of you know, relatively simple ways to actually to trade. But one of the interesting comments about MACD is that, you know, it's like all indicators, it's a little bit slow, it's a little bit lagging. And Armin, this is a question you asked a little bit before. Okay, it's, you know, Armin says that MACD is a lagging indicator, and it found that, you know, nothing happens unless in the forex unless two things cross. Okay, and run across MACDs with its own EMA. All right, so what you're talking about there, Armin, is yep, it is MACD is a lagging indicator. Okay, what it is, you know, for those of you who are completely new, a lagging indicator means that, you know, it's an indicator is created off OHLC data, the open, the high, the low, close data from the price. So it is an indicator is always going to be slightly lagging behind price, which means that, you know, we need to sort of you know, you need to factor that in if you're going to trade signal line crossovers or 0 level crossovers. Well, then you have to factor in that and understand that you can that will be part of your trading experience. Okay, so but what I'm going to do is I'm going to show you a little bit of a way that you can overcome that, and it's a way that I would use MACD. Okay, it's you know, it's a little bit of a way to give you a little bit of an idea, a little bit of sort of a heads up, okay, towards the possibility of a move beginning, and that can be used once again to give us an opportunity to enter perhaps the potential new trend much sooner. And with that, of course, then that allows us to you know, you know, sort of accept more reward for perhaps a little bit more risk. So Armin also said that, you know, I can't use the MACD by itself. I need other indices to confirm the nasty lagging MACD. So, well, hopefully, Armin, what I'm going to do is I'm going to show you, you know, how we can sort of get beyond that. Okay, and I'm also going to show you how coupling it with other elements starts to come together to build a trading plan for yourself, Armin. So what we're going to talk about is divergence, and as I've put there, it's kind of my favorite way to use MACD. It's simply put, you'll see divergence is when the MACD and actual price are not in agreement. Okay, so what we mean by that is, you know, as we see, you know, as MACD makes a newer high, but price fails to make a newer high, well, then, you know, there is a divergence. Okay, there is a divergence between what the MACD is doing and what actual price is doing. And when we see that, and when we can understand and read that, well, then that actually becomes a leading indicator, because when any strong move, whether it to be to the upside or to the downside, at some point, okay, it will start to run out of momentum. Okay, it will start to run out of momentum, and when we start to see divergence, that's starting to give us an indication that momentum is waning from the particular trend we're in, or the move we've just been watching or participating in, and actually the likelihood is that price is about to sort of just change its direction. And that is in a way that we use MACD to become a little bit, MACD goes from being a lagging indicator towards it becoming a bit of a leading indicator. I'm going to show you how that works, and how we can utilize and develop that for our own particular trading. So here we go. This is an example of bullish divergence. What have I got here? This is the euro yen chart here. Let's get the pen up there as always, so I can draw with it. What we've got here is euro yen, and this is a monthly chart. Okay, this is a monthly chart. This is it's a big old chart here. Okay, this is a chart covering years. And what I want you to see is, I've just drawn in a couple of the lines here, and we're still using traditional MACD here, and we're going to talk more about that in a slide or two. What we can see here is that price actually made a new down. Okay, it's a new lower low. All right, made a new lower low. I'll just remove that. I would say that, ladies and gentlemen, I would excuse my drawing. I'm a better trader than I am an artist. So, but what we can see here is that definitely, we had price move to a lower low. But what we would be expecting, okay, if price is moving to a lower low, I'd be expecting the MACD to also be moving to a lower low. Okay, I'd also be expecting it. But hopefully you can see here on the traditional MACD to the base that actually it doesn't, does it? As price makes a lower low, actually the MACD, okay, the MACD is making a higher low. All right, it doesn't follow through. There is divergence between what price is doing and what the MACD indicator is doing. Okay, this is divergent. In this case, this is what we'd call bullish divergence, because what we're seeing is we've been in a downtrend, price and the MACD, the beneath the waterline, the zero level, and actually what we're expecting is that bullish divergence is giving us an indication, okay, that the bulls are starting to step in. All right, the bearish momentum is starting to wane, it's starting to run out of energy, and actually the bullish momentum, the bulls are coming back into the market, and they're starting to sort of build up and take control of the market. So that's that is a bullish divergence. Okay, so price makes a new low, but the actual MACD fails to make a new low. That is giving us an indication that there's a good chance, there's a good potential that the market may be about to turn, and with that, that gives us an opportunity to sort of to jump on board a new trend. And in this particular case, this was this is the monthly chart. So actually we saw that realistically, we had a trend for almost 2 years after that. Okay, so of course on a monthly chart you don't get to see that, you don't get to see signals very often. All right, that's understandable, and it might take a year or two for your signal to sort of start to build. But the reality is, on the flip side is a case of when you do get a good signal, well then the opportunity to ride a trend for a long period is remarkable. Once again, okay, ladies and gentlemen, it comes down to knowing what type of trader you are. We had a chart there a few slides back, which was 15-minute intraday chart on dollar against Swiss franc, and here we are, monthly chart of euro against yen, a complete other end of the spectrum. But as always, we just want to show you the sort of the different different instruments and different time frames that these concepts can be utilized upon, so that you can actually go away and test and check and use them tomorrow. So that was bullish divergence. Now let's have a look at bearish divergence. And what have I put together here? Well, here we have, this is pound against the yen. This is an hourly chart. Okay, pound against the yen. Always known as a little bit of a dragon. Okay, the dragon. So it's pound against yen has calmed down in its old age a little bit. It used to be a very, very wild trading instrument. Okay, it wouldn't be unusual in the old days for pound against yen to perhaps move somewhere between 250 to 350 pips in a day, in a really very strong volatile day, and invariably, that was beautiful. If you're on the right side of that move, then it was a beautiful trade. If you're on the wrong side, well, it could be a bit of a challenging day. But even still, that's why it was called a dragon, because it felt a little bit sometimes like you're trying to hold on to a dragon's tail when you were trading it. But we've seen that maybe that volatility has disappeared a little bit, but it still has some great moves. It still has, when it does move, it moves nicely. And what I've got here is a nice example on the 1 hour chart of some bearish divergence. So what are we looking for in bearish divergence? Well, hopefully what you can see here is that price made a new high. Okay, price made a new high. Okay, we can see that it's got back up above its averages. It was trending up. Price makes a new high here. Okay, from the previous high the day before. Where MACD had made a very nice good high. But what happened, we can see there hopefully, is that price makes a new high, but actually, okay, the MACD doesn't follow. All right, that doesn't follow. The MACD actually shows a lower high. All right, shows a lower high. It's that indication there's a divergence. Okay, the momentum is waning. All right, the bulls, okay, who grabbed this and and wrestled it and dragged it north. Okay, they are starting to lose control. All right, maybe they're taking profits. Maybe it's at the prices at a level where the bears are actually want to they want to step in. Okay, whatever the reasons, we can see that when price makes new highs but the MACD fails to follow through, that is telling us that momentum is changing. And then actually what you can see is that not long after that, price rolled over and fell very, very nicely. Okay, it fell very, very nicely. And for those of you who are who might be looking at, say, well, you know what, Paul, I'm quite a risk, I'm a risk averse trader. Well, you had the sort of kind of the zero line kind of cross there, which is probably a little bit overnight, okay, in the European session. All right, but you can see that that's even there. In that case, yes, you gave up quite a lot of profit, but there was still a bit of a nice run going on there, okay, until it actually we had a signal line cross the other way. And even though we had a signal line cross the other way, we can see that just let me just clear off a little bit here, just clear off some of this. Even though we had a signal line cross here, we can see that actually price continued down for another day or two. But what we could also see is that as price was continuing down, the MACD was starting to make, the MACD was starting to sort of make higher lows. All right, so this trend was coming to an end pretty clearly, and we'll probably see that sort of turn around tomorrow, I would suggest. Okay, this is coming into this week on pound against yen. But this main example is about bearish divergence, namely, okay, price makes a new high. All right, but the MACD doesn't follow. All right, the MACD doesn't follow, and hopefully you can see that's quite clear. It takes a little bit of time to sort of train your eye to be able to see this and to view this. But once you're able to recognize it, well, then you'll never lose it. Okay, you'll never lose it. You'll never lose that ability to not see divergence on particular charts. So that's divergence, and divergence is the way I've used MACD, okay, for trading currencies. Okay, that'd be my preferred way, okay, because as I say, you're using the indicator, okay, to give you a bit of a heads up about a change in the underlying momentum within that market, and that is where it becomes, it goes from being a lagging indicator towards being a leading indicator, and that's what we're actually looking to engage with. So as it says there, so get changes in momentum that can precede a significant reversal. However, nothing is perfect, right? There's no trading method that is perfect, okay? None at all. And actually, what we look for is, what I look for is a confluence of events to help us make a trade decision. Just because I've got divergence there, just because I've got bearish divergence there, that doesn't mean that I'm just going to, hit the ask button, okay, and sell my positions, okay, as strongly as I can. What I like to see is a confluence event. This kind of links into Armin's question a little bit earlier about moving from being a lagging indicator to turning it into a leading indicator, and then also about starting to pull together a couple of other little pieces, okay, to make a trading plan, which gives you a trading method. And what I talk about is looking for a confluence of events to help us make that trade decision. So what I say is, you're looking really for 2 to 3 elements, okay. The 3 is as De La Soul sang in the early 90s, 3 is the magic number. All right, so ideally I like to look for 3, okay, 3 elements to come together, but sometimes it can just be 2, sometimes it might be 4, okay. What I do say is that 3 is a good number. If you're waiting for 5, 6, 7 elements to all to come together, well, then you might be waiting all year for a particular trade, okay. So give yourself a little starting target of 3 elements come together. That's where at one particular point, that's where you're looking to sort of say, yep, that's my trigger. So what I'd be looking for is MACD divergence, along with perhaps a break of a trend line as well. Once that happens, that gives me my trigger, or there is a break or a bounce off a significant level of support resistance. That could be a horizontal level of support resistance. That could be a set of trend line. It could actually even be a significant number, sometimes a big round number, okay. Maybe for example with cable pound against dollar, it's been flirting with 130, okay, for the last week until Monday, okay. So it can be a trend line, it can be support resistance level, it could be a big round number. What you can also do if you have access to it, some traders will look for MACD divergence on a higher time frame. So let's say the daily chart, and then they'll actually use just a normal trading moving average crossover trading strategy on a lower time frame. So if they're on if they see divergence on the daily chart, they might go down to the 4 hour or the 1 hour to look for a just a simple moving average crossover in the direction of the supposed way to trade. What you could also use is price action patterns. So what I mean by that is that you might see just very nice simple reversal patterns, things like double tops, double bottoms, triple tops, triple bottoms. You might see 1, 2, 3 patterns, okay. So if you're getting divergence followed by if you're getting bearish divergence followed by a double top, okay, on the chart, well, then that's starting to give you some really nice indication. You're getting a confluence of events. There's a few things coming together to give you an indication that there's a good chance that we might see a change in direction of that trend, and we might want to look to sort of position ourselves accordingly. And what also might be candlestick patterns, just simple candlestick patterns. So things like engulfing candles, things like pin bars, things like inside bars, key reversal bars. Okay, if you look back into the value trades webinar archive, I did a session at the start of this year about price action trading where I covered all of those particular candlestick patterns. So by all means, just make sure you check that in the webinar archive. They'll be all there for you to utilize. But more importantly, it's about, as I said, that confluence of events. We get MACD divergence show up, and then we get a couple of other things come together, and that is what gives us our trade plan. Okay, that is what gives us our trigger to give us an opportunity to sort of take a trade with a higher probability of a positive outcome, and that's what we're particularly looking for. So here's an example here. This was that euro yen monthly chart which we just looked at there. Okay, let's just get the old pen out there. We had the euro yen monthly chart. This we had a bullish divergence here. Okay, so we can see price was making a new low, but actually the MACD divergence, we had bullish divergence because MACD was making higher lows. Okay, there was divergence there. But as I said, just because you're getting divergence, we don't just buy the market. Okay, what I like to do is to see a bit of a confluence of events. So once the divergence was basically for me confirmed, once we had this trend line break, this is the blue line here, we had a trend line break, then also we had a very we had a bullish rejection candle, bullish pin bar there that actually also closed above the sort of 20 period moving average there. Okay, it closed above there. So we had in this area, okay, in this area here, we had 2 or 3 things all coming together, all right, at the same time. We had a confluence of events which would have allowed, you know, me or you as a trader to make a decision to say, right, okay, I want to be I want to be the long trader. You know, and that would have allowed you to give you some confirmation, okay, get ahead of the curve. If you think about it here, you know, you're probably realistically, you might have been looking at, you know, if you'd have been waiting for the sort of the zero line crossover there, okay, well then, you know, you'd have been entering the trade there. Now, of course, yes, it did go nicely up, but you know, it was the opportunity here for you to sort of to trade there. Okay, so it's a case of, you know, see the divergence, okay, on the MACD indicator, then wait for, you know, things like trend line break, candlestick pattern, you know, getting across a sort of a major moving average, you know, bounce or a break of a moving average across a, you know, a major number. Okay, just as I said, bringing two or three things together, okay, that gives you the idea of a good trade plan. So Armin just asked questions about, you know, when you talk about moving average crossovers, what values would you assign to the moving averages to give you the best chance to take advantage of potential price action reversals? What I'd say, Armin, is, you know, I use just very there, you know, sort of a 20, a 50, and a 200. If you want to use, let's say, if you want to use the let's say a lower time frame moving average crossover entry for your divergence trades, well then, you know, you might want to sort of, you know, you might want to look at, you know, maybe you know, a couple of shorter time frame moving averages. So something like maybe you know, maybe a 10 and a 20, you know, or possibly a 20 and a 40. So you know, moving average crossovers, there's a case of, you know, you can test them to your heart's content to find out which one you are most comfortable with. Okay, it's more about, you know, just, you know, you see the divergence, let's say on the daily chart, and then you go down to the 4-hour and the hourly chart, okay, to hopefully give you a little bit of an early and a tighter entry. Okay, so once again, it becomes down to your risk profile. Some people might not really like that idea. Some people might be quite happy to sort of wait and, you know, all play out on the time frame they're trading. Other people who are more aggressive as traders might say that that's, you know, that's a great, you know, that's you know, how they want to engage with the market, and so they'd be happy to do that. So once again, it's a little bit about, you know, knowing what type of trader you are and knowing what your own particular risk profile is. Let's just go back here. So here's another example. Okay, here what we've got is, this is the weekly chart on the pound against the dollar. Okay, this was a lovely trade. This was a lovely trade here, pound against the dollar on the weekly chart. You know, we've had you can see yourself, it was a kind of a nice uptrend, almost like a channel. And you know what we had here. Okay, you know, this, you know, the price over here. Let me just draw into that. Price made a new high, okay, a new high, but MACD failed to make a new high. Okay, we can see from that last peak to there, price makes a new high, but the MACD fails to make a new high. It actually makes a lower high. Okay, there we have. So that's the first indication that, you know, hang on a minute. But at the same time as it happens that, okay, price has run in. Let me just remove these and erase the drum. Price has also run into my green 200 period 200 moving average, 200 weekly period moving average. Okay, it's been a long day. You know, price hit there, and also on the weekly chart put in, this is, you know, an engulfing candle here, and it's a key reversal candle as well. Okay, price pushed to those new highs but closed, okay, beneath the low of the previous 2 weeks, I think there. Okay, so once again, you had 2 or 3 things all coming together at the same time. You had bearish divergence, you had price hitting the resistance of the 200 period moving average, and then also putting in a price action there. Okay, but putting in you know, a price action candlestick pattern there. So, you know, invariably that, you know, we have there, okay, you know, we've got 3 things that have come together there at a very nice point, and that gives an indication that, okay, we're ready to be short. Some people would have, you know, shorted the sort of the base of that engulfing candle. Some people may have waited for the, you know, price to get beneath the 20 period moving average. Some people might have waited for it to break the, you know, this supporting trend line. Some people who were maybe trading the zero line crossover here would have been getting short probably around about here. Okay, so it's, as I said, it's about understanding who you are as a trader. What's your risk profile as a trader? What type of trader are you? Okay, are you an aggressive trader or are you a risk averse trader? There's no right or wrong. It's about knowing who you are, okay, and trading in line with that. Okay. So yeah, this was just another example. This is dollar CAD on the weekly chart. Price had a real rally up there. Okay, real rally up there. Okay, to the start of it. We can see there. Let's get the pen out there, Paul. Okay. We can see price. You can see that price had a real push, but it just couldn't. It couldn't make a new high there, could it? It just didn't like it at all. And then then actually what happened is we had an engulfing candle there as well. Okay, real pushed up to new highs. Okay, went parabolic. What does that mean is that as it was going up, it was almost getting it was going faster and faster and faster. And anyone who studied or remembers kind of studying gravity at school, the sort of the quicker something goes up, the quicker something's going to come down. All right, and that's the same here. We've had a nice trend, but then we can start to see those last few weeks it's just getting up and up, and then it just comes all the way down again. Okay, so we had kind of a parabolic move up. We had a bearish divergence happening, and then we also had a big engulfing candle, big weekly engulfing candle happening there, and then you can see actually for the next few months price fell away. And once again, as I said, that's just watching out and having a look. Okay, and just once you see the divergence, you're able to identify it on the charts, then just being able to sort of wait for 2 or 3 other things to come together, and that gives you your opportunity to take your trade. Okay, now, as I said, we're moving from plain MACD, signal line crossovers, zero line crossovers, from being a lagging indicator towards using divergence, which is a leading indicator, towards using a confluence of events, which is taking you towards helping you make much better trading decisions. So here we had on the chart. This is just arm and this wasn't a crossover per se, but what we had here on the left, this was the weekly chart. Okay, which is what we've just looked at. But then actually, what I've put in here was the daily chart as well. Okay, the daily chart had a nice big pin bar there, rejection candle. Okay, and then actually what we had was a signal line crossover there on the MACD. Okay, on the MACD on the daily chart. All right, we could see that the divergence was building on the weekly chart, and when we saw they had a signal line crossover. Okay, then invariably you could have that would have been a possible entry point, or you might have even gone down to sort of, as I said, using it. I don't have it on here, but I would suspect probably a 10-period moving average probably would have crossed around here. Okay, and that might have given you the opportunity to sort of get in a little bit earlier than waiting for the big sell-off in that particular case. So very often what I find myself is that weekly charts and 4-hour charts, they make a nice combo. Okay, it's very possible to see trades setting up on the weekly chart and then execute them on the 4-hour. So there is a little bit of a fly in the ointment. Okay, hopefully that's giving you a little bit of insight. Okay, but there is a little bit of a fly in the ointment. As I said, I've been talking about using traditional MACD. Okay, whereas actually the MACD that comes on MetaTrader is a little bit different from traditional MACD. Now, what I've done is I wanted to give people the traditional insight because people trade on several different platforms. Also, there is the ability to download a traditional MACD, from across the internet. It's not terribly difficult to find, but the MetaTrader MACD is created a little bit differently. So most the traditional MACD uses EMAs. Okay, the MetaTrader 4 MACD uses both EMA and SMA. So you get a little bit of a different visual representation, right? So some people sometimes maybe put off by that, or they don't understand it. Is all hope lost to put that? No, not at all. You just need to understand, you know, how it's represented a little bit different. The ideas, the concepts we want to use, they're exactly the same. You can see there maybe on that chart there, you know, on the bottom one you've got the sort of traditional MACD, and then on the top one we have the sort of the MetaTrader standard MACD. Okay, you know, it looks a little bit different. I'm going to sort of try and show and explain that to you now. So, you know, as always, it's, you know, we're traders, you know, we adapt and we overcome. All right. So, you know, what happens here is that the MetaTrader MACD is the signal line. Okay, let's get the old pen out here. The signal line. Okay, the signal line, which is, you know, the red moving average here on the MetaTrader MACD, it is the same as the signal line. Okay, on the traditional MACD. Okay, it's the same. All right, signal line is the same. Okay. What is different, what is changing, let's get rid of the drawings. What is different is the MACD line, okay? So the normal blue line, okay? The normal faster blue MACD, that is now what is represented by the histogram, okay? On the MetaTrader standard MACD, okay? That's all it is. That's what it is. The most important thing for us is that, you know, it still shows us divergence. Okay, that's, you know, that's where I want you to focus your work on in terms of understanding divergence. It'll still show you divergence across the across the particular charts. So as I said, it's a little bit of a different representation, but in terms of how to use it for MACD, that is still the same. That's still there for us to use. Okay, so it's still a valid way for us to trade. So what I have here is this is the 4-hour chart, okay, on the dollar against the yen. So, you know, we can see, you know, it's been in a nice uptrend there, hasn't it? We saw price made, you know, price made new highs, okay, drawing a trend, just a, you know, quick line there. We can see price made new highs, okay, but on the traditional MACD, okay, it failed to make new highs, okay, it made a lower high, and on the standard MetaTrader 4 MACD, okay, you saw the divergence there as well. Okay, it's, you know, it failed to make a new high. Okay, so just remember the histogram. Okay, the histogram on the standard MetaTrader 4 MACD is the same as the MACD line. Okay, in this case the blue line on a traditional MACD. That's what it is. The signal line stays the same. The histogram is, you know, is just slightly. The histogram, excuse me, is representing the MACD line. So divergence, okay, divergence is still valid, okay, and that's the important thing I want you to take away from it, okay, that it's still very, very usable, okay, and in some respects, because the histogram sticks out a little bit, in some respects it can be a little bit easier sometimes to see the divergence, because the histogram is a little bit clearer, a little bit more bold than the actual than the traditional MACD line. And so here's an example. This is the Swiss against the yen on the weekly. You know, I primarily am a weekly trader, okay, and you know, I think MACD divergence and such on you know, the higher time frames, pretty much like everything. You know, it has a, you know, it's a little bit you know, works a little bit better on the higher time frames, okay. But hopefully you can see here that you know, let's get the old pen out. We can see that, you know, price was pushing to those new lows, okay. But actually, you know, on the traditional MACD, we were getting, you know, higher lows on the MACD line, and also on the standard MetaTrader 4 MACD, we were also getting, you know, divergence. We were getting bullish divergence on the indicator there itself as well. Then what we had was, you know, we had you know, you can see there, you had a little bit of a, you know, you had a trend line break there, okay. So you've got the MACD divergence coming, followed by a nice trend line break, okay, and then yeah, the trade was on, the rally was on, okay. We were hot to trot, ladies and gentlemen. I remember that trade very, very well. So there we go. Let's just get rid of that. So in conclusion, ladies and gentlemen, all right, okay, trading currencies with MACD is very feasible. It's very, very possible indeed, okay. And you know, MACD can help you, okay, in the right environments. It can help you to identify possible new trends, okay, and also you know, momentum, okay, the strength of that trend. It is like every other indicator. It is a lagging indicator if you use it in its like say its standard sort of settings. Okay, you're using something like a signal line crossover or the zero line crossover. But once you start to be able to identify divergence, once you're able to see divergence, okay, and see it on your charts, that's when it starts to become a leading indicator. All right. But what I tell you is, don't get too excited. That even with divergence, it might only work just 50% of the time. Okay, so just as I said, just because you see divergence doesn't mean you hit the bid. Okay, it doesn't mean you do that. All right, what you need is you need a trigger, and that trigger comes from having a confluence of events. Start to bring 2 or 3 things together. Okay, bringing a trend line breaks, bounce or breaks off levels of support, resistance, or big round numbers. Okay, start to see price action patterns, double tops, double bottoms, 1, 2, 3s. Okay, starting to see candlestick patterns, engulfing candles, rejection candles. Okay, inside bars, key reversal. Start to pull them all together, ladies and gentlemen. Okay, start to pull them all together. Okay, and that is what actually allows you the opportunity to sort of build a trade plan. And that is how I would like you to sort of to your takeaway, to actually go away and spend a little bit of time just looking at how you can bring those elements together, have that confluence of events that would allow you to use MACD to sort of trade currencies on the Value Trades MetaTrader 4 platform. So there you go, ladies and gentlemen. I do apologise, that we had a little bit of a little later start than I'd hoped for. There's technology fighting the technology, but we're there and we got there. I hope you found that useful. We've just got a couple of minutes left, so what I'll do is I'll just try and switch, just across to the charts. We'll just have a look at 1 or 2 very quick charts. I appreciate we've been going for a good hour or so, and hopefully that will just give you a little bit of an idea of how to utilize this. If you've got any questions, ping them away. Alternatively, have a chat with your account representative. They'll be very, very happy to talk you through this. Very happy to show you how to utilize it on the Value Trades MetaTrader 4 platform. So just bear with us, and what we'll do is we'll see if we can get the charts up. Okay. So yeah, what I've got here is, I've got this. In fact, this is the Swiss yen short trade that we looked at before. Okay, as I said, you can see that. Here we go. What I'm going to do is I'm just going to put in another indicator here. Just bear with me one moment. I'm going to put a 10-period moving average in. Let's make it a bit purple, shall we? Something to stand out a little bit different. Okay, and I don't want it on the weekly chart. I want that's just to be clear, but let's have a look at maybe on the sort of the daily and the 4 hour and the 1 hour, right? So this will hopefully sort of answer Armin's question. So as we looked at in the slides and what we discussed, okay, price was going down, price was making new lows, right, but actually was making higher lows on the MACD. Okay, and also what we started to see there, what I'll be saying is the first sign is here this is a double bottom. This is a double bottom it was making here, couldn't make a new low. Okay, it's forming a double bottom with bullish divergence. There's a trend line there which breaks. Okay, and then away it goes. Okay, and what I'll be looking at is that if we just zoom here. Let's just bring us to that. Here we go. It might not go back. It might not necessarily go back too far on the on the daily charts. We'll see. I think we might run out of steam on there, but we'll use it on another example. Okay, we'll find another example. I just basically wanted to show that how we had that if it had gone down on the lower time frames, what you'd have been able to see is that around about here you'd have probably had, I suspect you'd have had a let's say a 10 and 20 period moving average crossover. Okay, on the daily charts that would have given you an opportunity to take a little bit of an earlier trade. Okay, once you've seen this particular trend line be broken, and then invariably what we can see is that price rallied away there. But let's have maybe a little look and see if on the pound against the US dollar. That's what we had there. Let's see that showing how that on this chart, it's not the same as my normal charts, but there we go. This will do us. Okay, so that'll do. Visualization, take it off there, put it on there. Okay, so here we had that. Let's get our data in it. Here we had that happening there around about 15th of April. Okay, and if we'd zoomed out there, so hopefully you can see we had the divergence on the weekly chart, but also I'm hoping that you can see that we had the divergence also happening on the daily chart as well. Hopefully you can see that there, and then what we also had was here we go. Let's just put it in there. Is a bit. Sometimes it's a bit easy with a little bit of thing, but then we had there we also had there we had the kind of the sort of the 10 crossing the 20 period there on the daily chart as well. So utilizing that as a kind of a little bit of an early opportunity to enter that particular trade there on the daily chart. I suspect we'd have had a little bit more on the on the 4-hourly chart. That would have had you in there a little bit. Here we go, round about there. Okay, so once again, it becomes that element of what's my trade appetite, or rather my risk appetite when it comes to a trade. So there is just hopefully that was a really kind of a nice move. I mean, because you're looking at it on the weekly chart, it's you can watch these things setting up. Okay, as I said, it takes a little bit of time, right? But it takes a little bit of time. But actually, if you're looking at most of the major currency pairs, and of course there's plenty of them these days. Plenty of these value trades offer a whole host of of the sort of the majors and the exotics. Okay, for you to be able to trade. Well, then actually here you have it there as an opportunity to sort of sit and wait, see these divergences break through, and then actually find a way to engage and work with those particular trade setups. So there you go, ladies and gentlemen. We'll kind of call it a little bit of a night there for this evening. I hope you found that useful. I hope that gave you a little bit of insight into what the MACD is, how MACD can be used for trading. As I said, going from having it as a lagging indicator to a leading indicator to a proper trade plan when it's has those a confluence of events. As always, I wish you the very best of success in your own trading, ladies and gentlemen. And if you're watching this on demand and you have questions, then by all means, give your account representative a shout, and they'll be very happy to sort of talk you through what we've discussed here and show you how to utilize it on the Value Trades MetaTrader 4 pattern. So thanks very much for that. I think there's a little question there from Armin, which I'll just take, and then we'll finish up for the evening. So Armin talks there about excuse me. I think you're just trying to find your question there, Armin. There's a good few from you there. I appreciate you getting involved and asking questions. So yeah, it is a case of using sort of having that divergence, using that confluence of events, and then just as I said, a couple of other indicators, not even indicators, can just be quite usually simply price, a couple of moving averages would give you enough ideas to basically sort of build a trade plan. Okay, you know where you're getting in, you know where your exits are, you're wrong, and actually also you'd know where you're where you're looking to trade to. Okay, so as I said, yeah, it needs a little bit of patience, okay, to wait. But the good thing is that you can cover an awful lot of currencies. You don't need to be sat there every minute of every day. Okay, it allows you to basically to sort of almost like think of it like almost like setting an ambush. Okay, you're almost like setting an ambush. You're looking to sort of take your trades. Okay, you're looking to sort of wait for an ambush. You can see the divergence happening. Then that starts to almost like hone you in a bit like a sniper, and then you're starting to look for, well, where is my trend line break, or where is my moving average crossover, or where is my price action pattern or candlesticks. Okay, you sat waiting for them to happen, and then as soon as you see them, well, then the trade idea is on. Super. All right. Well, as I say, I wish you all the very best of success with your own trading, ladies and gentlemen. Thank you for joining me this evening. It's been a pleasure to share that with you, and I look forward to seeing you at the remainder of the Value Trades webinar series for the remainder of 2018. And yeah, good luck in your trading. Thanks very much, guys.